Hey everybody, today I assigned you a reading about the stock market crash of 1929, also known as Black Tuesday. I wanted to point out that even though that's the event that most people pinpoint as the start of the Great Depression, it is not the cause of the Great Depression. There are many factors that caused the Great Depression, the stock market crash including, but there are other factors that we're going to take a look at through different readings that also contributed to the Great Depression. So if you notice, I'm dressed like a 1920s stockbroker, or at least what I assume that they looked like. I got my hat, my pinstripe suit, my gold watch. So I'm going to do my best to explain how stocks work, how the stock market works, and how the stock market crashed on October 29th, 1929. Okay, so we're going to start with, well, let's just take a company, for example. Okay, I picked McClure's Pickles out of Brooklyn, because apparently Brooklyn likes to make artisanal products like pickles. So you take a company, and the company builds itself up as a privately owned company. Maybe there are four or five shareholders. The founder, maybe the founder's family, a handful of shareholders. Eventually, somewhere along the line, somebody's going to tell the owner of McClure's Pickles, hey, this is $1 billion idea. So why don't you decide to make it a publicly traded company? All right. What's going to make it a publicly traded company is you break up ownership of that company into tiny little parts called shares. Okay, there could be thousands of shares. Usually the owner is going to control over 51% of those shares, so he or she can maintain a controlling interest in the company. But either way, when a company decides it wants to go public, they issue an IPO, an initial public offering. And if you look at the Shake Shack picture on the right, these would be the owners of Shake Shack ringing the bell in the New York Stock Exchange the day that they had their IPO, their initial public offering. So now this privately owned company is going public, and everybody and their mothers can buy shares in McClure's Pickles. Okay, usually when a company issues an IPO and goes public, it's pretty hot. Everybody wants a piece of this. They think McClure's Pickles is going to soar through the roof. So it's a pretty hot stock the day that it's offered for the first time. All right. So stocks begin to rise because especially in 1929, everybody was buying stock, and the prices of the stock just kept on rising. Nobody knew why, nobody cared. They just kept rising. Intrinsically, what's a pickle company worth? They don't have anything that another pickle company can't do. It's friggin' pickles. Okay? But the price of these pickle companies, or the price of Coca-Cola, or the price of whatever back in 1929 just kept on rising. So everybody wanted to get in the game. Okay? So you had small time investors, you had stockbrokers pushing it on their clients, you had banks getting involved, buying tons and tons of stocks, buying thousands, millions of shares of stocks, because it was a safe investment in 1929. Nobody could remember the last time that the prices of stocks had decreased. They only increase. And so what you do is you buy stocks when they're lower and you sell them when they're higher, so you can make a profit. So if they just keep on increasing in value, you're always going to make a profit. So now there were a lot of investors who either wanted to get in the game but didn't have the money, or had already invested all their money and needed some more money. So what did they do? They went to stockbrokers to borrow money. Okay, this is called borrowing on margin. Come back to that. This is called borrowing on margin. So if you don't have enough money, you go to your stockbroker, they will loan you the money, even if you can't pay it back. Because they're going to assume, and you're going to assume the same thing, that when you buy a stock, you're going to end up holding on to it for a few weeks or a few months, and then you're going to sell it for a profit. You'll be able to pay back your loan, and you'll still have enough of a profit to invest again in another stock. So investors felt safe, stockbrokers felt safe, banks felt safe loaning money on the margin, and so everybody was borrowing money on the margin, which is going to become problematic. There are other types of investors, usually banks, sometimes big-time businesses that are called holding companies. JP Morgan is an example of somebody who owned a holding company. The House of Morgan was a big holding company. We called it investment banking, but in essence, he had a big holding company. What that means is his company, JP Morgan or House of Morgan, owned hundreds of different companies. They owned a controlling interest in AT&T, in General Electric, in American Skyscraper, I think it was. U.S. Steel, forgot about that, was the big one. They owned controlling interest in those companies. And when you have holding companies like this, sure, they make tons and tons of money. They have so much influence. But if you look at this diagram, if something were to happen to U.S. Steel, if the price of U.S. Steel were to start to decrease, that wouldn't just affect U.S. Steel and all of U.S. Steel's shareholders. Because U.S. Steel is controlled by JP Morgan, it would affect all of his other subsidiary companies, like AT&T or General Electric, and anybody who owns shares in that. So these holding companies tied everybody together and made it that much more of a risky venture for people investing in the stock market. Okay? So now that everybody's got their money that they borrowed on margin, they can start spending it, making it rain like P. Diddy over here, and buying lots of stocks. And that's what was going on in 1929. People were buying stocks like never before because they just kept increasing in value. And what's happening here is they're creating a bubble. And a bubble, if you paid attention to the reading, a bubble is what happens when you just start artificially inflating the value of stocks or real estate or any other traded commodity based on nothing but hot air, so to speak. BS. Okay, there's no real reason that the price of McClure's pickle stock should be continuously rising, but it is. Okay, so people are assuming that the stocks are going to rise, and the prices of the stocks keep rising, so the bubble keeps on inflating. And if we know anything about bubbles, if you inflate it with too much hot air, it's eventually going to pop. So what caused the pop? Well, somewhere along the line, somebody, and nobody knows who, nobody knows exactly what caused the crash, but somewhere along the line, somebody probably thought to themselves, why do stocks keep rising? The stocks that I own, they shouldn't rise. Maybe, my company had a bad quarter and yet the value of the stock kept rising. I think I'm going to do the smart thing and get out now. I'm going to sell. And so while everybody's buying, this guy decides to sell. And now somebody catches on. They're like, wait a second. If this guy's selling, he must know something. I'm going to sell. And they call up their stockbroker and they're like, sell, sell, sell. And this begins a trend where when one person starts to sell and two people start to sell, now everybody thinks, oh my God, something's happening. We need to get out now. And more people go to sell. This is a scene from Trading Places. Highly recommend you watching that movie. And so when everybody decides to sell, now all of a sudden the balance is shifted. It's that whole supply and demand thing that we talked about in class, where if the demand is high and the supply is low, the price is going to rise. And that's what was going on with the stocks. But now all of a sudden that everyone wants to sell, the demand is very low because nobody wants to hold on to their stock, but the supply is very high. So that's going to drive the price down. Okay? And now, at the end of the day, everybody's trying to sell and nobody's looking to buy. And the value of these stocks is now at rock bottom. because nobody wants to buy them, everybody wants to sell them, and the bubble has burst. So, what happens now at the end of the day when basically the paper that the stock is printed on is worth nothing more than the paper itself, and you're left with no money and no value, so to speak of? Well, the bank's going to call, or the stockbroker's going to call and say, hey, I loaned you money on margin. You need to pay back that money. That's called a margin call. So here's what that looks like. All right, now you're looking, you got to pay back your money, but you don't have any money. So what's going to happen? Well, the bank's going to foreclose on your home. The bank's going to repossess your car. The bank's going to garnish your wages. They're going to take whatever they can to repay the money that you owe them, or the stockbroker. And if it's a stockbroker and a stockbroker can't do that like a bank can, well, the stockbroker is basically out of luck. He's just lost all his money and all the money from his company. And there were rumors of a lot of stockbrokers jumping out of windows, although I'm not exactly sure that happened. So margin calls, regular investors realize they've got nothing left, and they're going to be going through some hard times. Banks and stockbrokers are like, how did this happen? We didn't see this coming. And everybody in America is going to be experiencing an economic depression. Okay, so thanks for watching, and I'll talk to you later. Bye-bye.